I've got 15 individual tax strategies to avoid W-2 taxes. And look, they're all legit. They're all 100% legal. So let's say, for example, you are single and you are planning to earn $100,000 of W-2 income in 2022. And that's it. Like, you don't have any other tax strategies or you don't have any dependents for simple math. Well, then the numbers will look something like this. Okay, you'd have $100,000 in W-2 income, and then you'd have a standard deduction of $12,950, which, by the way, a standard deduction is a deduction that everyone gets unless you decide to itemize, which would then make your taxable income $87,050. Thus, your effective tax rate will be 16.97%. And so the total taxes you will pay on a $100,000 income will be $14,774. So to summarize the math, nearly $15,000 or 17% of your income is being paid in taxes if you earned $100,000. Now, many people may not feel the brunt of these tax payments because they make smaller payments throughout the tax year on every single W-2 check. And if you look closely at the end of the year, or if you look at your W-2 statement, then you will realize how much you're actually paying in taxes. But look, there are 100% legal ways to reduce these tax payments. So in this video, what I want to do is simply cover my 15 legal individual tax strategies to avoid W-2 taxes. Stay tuned. Hey there, and if you're new, welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. Listen, I have some super great information to share with you today, and I know you're going to love it. So please share your support by hitting the like button so other people like you can learn about these individual tax strategies. Now, as I go throughout this video, I want you to tell me in the comment section below if you are already using any of these tax strategies. All right, let's dive in with strategy number 0, get an emergency fund. That's right, strategy 0, because before you start attempting to implement any tax strategies that I'm going to talk about today, it is really important that you have one seriously key thing established, and that is an emergency fund of at least 6 months expenses, because the golden rule of saving on taxes is this, okay? You want to accelerate your losses and defer your income, okay? Defer your income and accelerate your losses. So while you are deferring some of your income, it's really important that you have some savings in place in the form of an emergency fund to cover you in the event that your income starts to drop or goes down to 0. That way you don't have to reverse some of your tax strategies or end up losing out on some of your tax savings because your income dropped. For example, one of my tax strategies is to invest into a retirement account. And so I defer my income and the taxes that I would pay on that income by investing it into a retirement account. Well, if my income ever stopped, instead of me having to withdraw from my retirement account, I would be able to use my emergency fund until I could get my income back rolling. Okay, now that you understand that, let's go ahead and talk briefly about how this video is going to be structured. So I'm going to start out with some easy tax strategies that anyone can implement to avoid W-2 taxes. Then I'm going to move into some more intermediate level tax strategies. And then lastly, I'm going to build all the way up to more advanced tax strategies like investing into real estate, for example. And as always, I'll have the timestamps down in the description below so that you can skip to the part that you want to learn the most about. Okay, so my first easy tax strategy that anyone can use to avoid W-2 taxes is number 1, contribute to a retirement account. So many companies offer some kind of retirement account, usually a traditional 401k that you can contribute to. But if your company does not yet offer a retirement account, then you don't need to worry too much about it because there are many other retirement accounts that you can choose from as well. Now, while there are nuances with each retirement account, the premise is simple, okay? You don't pay any taxes on the contributions or investment growth inside of a retirement account, also known as a tax deferred account. Now, if you ever decide to withdraw from a retirement account before you reach the designated retirement age, which is usually 59 and a half, then you sometimes will have to pay regular income tax and could get hit with a general small withdrawal penalty. Now, the major pros of using a retirement account as a tax strategy are you can access your money at any time you need to, unlike some of the more advanced strategies where you assume more risk, and your money can grow tax-free. Of course, the major con is that you're deferring your income and it may take many years for you to get your money back tax-free. So the types of retirement accounts that I think you should know about are the traditional IRAs, traditional 401ks, the SEP IRA, and the simple IRA and simple 401k. Okay, moving on to the next tax strategy is number 2, contribute to a HSA or a health savings account. So this one is very similar to retirement accounts, but instead of saving your pre-tax income for retirement income, you are now saving for future medical expenses, because a health savings account or HSA is designed to allow people with high deductible health insurance plans to pay for medical expenses such as, paying for doctor's visits, or paying for any medical prescriptions, or paying for co-insurance plans, or drug addiction treatment if you need something like that, or even fertility and maternity services as well, and a whole lot more. Amazon even has an entire catalog dedicated to products that you can purchase using your HSA account. And I personally love HSA accounts because, I truly believe health is wealth. Like, what's the point of money if you're not gonna have health and be able to enjoy it? So I take advantage of using my tax-free money to improve my own personal health. Which, by the way, if you need help with tax planning, then we may be able to assist. Check out the first link down in the description below. Let's keep the contributions going with tax strategy number 3, the College 529 plan. Now don't worry, this video isn't about a whole bunch of contribution accounts or deferred tax accounts, but like the other two, a College 529 plan is an investment account where you can use your pre-tax income to pay for any qualified education expenses for a designated beneficiary. Now, normally beneficiaries would be your children or close family members, but you can also be the beneficiary and the contributor as well. So basically with a College 529 plan, you can defer your income and use your tax-free money to pay for stuff like college tuition and expenses, K through 12 private school tuition, apprentice programs, and student loan repayments. And the best part is you can use a college investment plan without impacting your ability to receive financial aid. All right, let's keep things in the family with tax strategy number 4, married filing separately. So for anyone married or planning to get married one day, it may be beneficial for you to claim your filing status as married filing separately. Now, I know, all right, you're married, you're in love, and you want to do everything together, but you may want to rethink that for tax purposes. Now, married filing separately is a filing status for married couples who choose to report their respective income, exemptions, and deductions on separate tax returns. And this could be useful when one spouse has significantly higher itemized deductions like medical expenses than another spouse. So for example, let's say that a spouse earns $200,000 and then the other spouse earns $50,000. And the spouse who earns $50,000 has medical expenses of, let's say, $15,000. Well, the rule around deducting medical expenses is that the expenses must exceed 7.5% of your total adjusted gross income, which for this couple would be $18,750. So they would not be able to deduct the medical expenses unless they filed separately. Now, I will admit that it usually makes more sense to file jointly because it makes it easier to qualify for a number of tax deductions and tax credits, such as the child tax credit. The next easy tax strategy that you can use before we move into more of the intermediate ones will be number 5, contribute to a donor advisor fund. Now, you may already know that you can write off charitable donations if you itemize on a Schedule A of your individual tax return, which does help you to avoid some W-2 taxes. However, that requires that you make a charitable contribution within that tax year. Well, with something like a donor advisor fund or DAF, you give yourself more time. Oh no, the tax year is almost over. I need to hurry up and make a charitable donation. Who should I give my money to? Hey, don't worry. You can always contribute to a DAF. Because a donor advisor fund, or DAF, is like a retirement account, but instead of contributing to retirement, you are contributing for a future charitable donation. So when you contribute cash to a DAF, then those contributions are eligible for an immediate tax deduction, and then those funds can be invested and grow tax-free, which makes your charitable donation even larger. So the flow looks something like this, okay? You donate to a charitable fund and then you get a tax deduction. And if you decide to invest it, it grows tax-free, and then you donate it to an organization that you choose. All right, so those were some of the easy tax strategies to avoid W-2 taxes. Now remember to let me know in the comment section below if you are using any of them. Okay, now let's move into some of the intermediate tax strategies that require you to have a little bit more money and take on a little bit more risk, starting with number 6, buy a home. So this is about buying a primary residence. Now, I put this in the intermediate category because, okay, everything in the easy category are things you can do almost immediately, like right after you finish this video. However, when it comes to something like buying a home, that requires a lot more effort, because now you may need to save for a down payment or find a really good property in an area that you like, which can be very challenging in this hot seller's market. And I know that because right now I'm in the process of buying my first home, and looking at the long-term tax benefits is one of the reasons why I'm deciding to pull the trigger. Because with a home, you can write off things such as writing off your mortgage interest and insurance premiums. You can write off your property taxes. If you sell your home, then you can take advantage of the 1031 exchange, and you can also claim the home office deduction. You can rent out your home, and so much more. Which, by the way, I'm working on a video that breaks down all the tax benefits of owning your home. So make sure you are subscribed to our channel so that you can check that out after you finish this one. Okay, the next intermediate tax strategy I want you to know about is number 7, opt for deferred compensation plans or employee stock. So once you start making some serious income, like $250,000 or more, then maxing out your 401ks and your HSAs and your IRAs aren't enough to make a serious dent in your tax liability. Well, another way to avoid W-2 taxes is with a deferred compensation plan, which is an agreement between an employer and an employee to defer compensation for a future point in time. For example, instead of you taking cash bonuses every year for your W-2 job, you may wish to take your bonus as company stock, which is a great strategy because you will pay additional taxes on any cash bonuses you receive, but not on the stocks you receive, at least until you sell them. And this is an option that many popular CEOs like Elon Musk prefer as a way to grow their assets or grow their businesses tax-free. So in general, if you see a compensation plan with employee stock options, please remember the tax benefits of taking it. On the other hand, if your employer does not offer some kind of deferred compensation plan, then you can try to negotiate from a different angle that doesn't involve a higher salary. Now, the big risk here is that it is not guaranteed the company's stock will grow. So keep that in mind, especially if you are not holding an upper management position where you can influence the overall success of the company. Now, if you're not in a position to negotiate a deferred compensation plan or employee stock options, then you may want to take matters into your own hands with number 8, start a side hustle. So anytime you start a side hustle or a new business, it is typical to face startup costs or experience a business loss in the first year. And these costs and these losses count as tax deductions that can lower your taxable income, thus allowing you to pay less W-2 taxes. Now, as I mentioned, some of these intermediate tax strategies assume more risk because now you are literally losing your capital or losing your money instead of deferring it. Now, of course, the hope is that your side hustle or new business grows into a cash flowing asset that more than makes up for any potential losses of your initial investment. But starting a business is tough and it is not guaranteed to be successful. So it's still important that you not overdo it, especially when you're first starting out. Okay, moving on to number 9, dump some stocks. So if you have invested into some stocks where you have unrealized losses and you no longer have confidence in the company's future performance, then you can dump it to offset some of your taxable income. However, there is a limit, okay? Your maximum net capital loss is limited to $3,000 in any tax year. So yeah, you don't want to overdo it. But just like you may want to dump some of your losers, you may also want to dump some of your winners too that you no longer have confidence in to perform for the future. So that way you can move out of positions that you no longer want and then move into positions while maximizing your tax outcomes. This is also known as tax loss harvesting. All right, let's keep moving along with number 10, long-term care insurance. So the tax benefit of buying a long-term care insurance policy is that a portion of the premiums are tax deductible when you choose to itemize on the Schedule A. Now, the reason why this is an intermediate strategy is, okay, this requires a long-term outlook, because you can't start using a long-term care insurance plan until you are no longer able to do a couple of basic living tasks, such as giving yourself a bath or dressing yourself or struggling to get in and out of bed or using the toilet. And okay, of course, no one wants to think about that stuff happening to them. And so this tax strategy often gets overlooked. But if you ever do find yourself in a situation like this, then you'll be glad that you invested early to help cover the expenses of where you need to get long-term help. All right, now let's move into more of the advanced tax strategies, which are reserved for people who are ready to make serious investments and take on more risks, starting with number 11, invest in real estate. Now, this is an advanced strategy because even though real estate is often known to be one of the safest asset classes in the world, the main thing that makes investing in real estate risky is when you are leveraging too much debt and then you stop making income to be able to service the debt payments. On top of that, it requires a significant amount of capital to invest and use real estate as a tax strategy. But once you can deploy this strategy, the benefits are enormous. So taxpayers who have less than $100,000 of taxable income per year can take advantage of the real estate passive loss rule, which allows real estate investors to deduct up to $25,000 in passive losses against their ordinary or W-2 income. And many rental properties record a paper loss because of a huge tax deduction known as depreciation. Now, there are a lot of other rules and tax strategies around rental properties. So if you want to see a video on it, please tell me in the comment section below. All right, the next advanced tax strategy is number 12, invest in business. Now, this coincides closely with the intermediate tax strategy of starting a business or a side hustle. However, I had to bring this back again for the advanced part because there is another layer to investing in business, right? Because if you have an existing business where you have established levers that produce a positive ROI or a positive return on investment, then you could intentionally invest more into your business and run the business at a loss, get great tax deductions, and then grow a bigger business asset, which is exactly what Jeff Bezos did with Amazon to grow it tax-free. On the flip side, you could also intentionally make private business investments where you know you may have a temporary business loss to reduce your current year's taxable income, like guys like Mark Cuban do on Shark Tank. All right, moving on to advanced strategy number 13, oil and gas investing. Okay, much like real estate and business, another asset class that you can invest in which offers many great tax benefits are oil and gas companies, because the tax code specifies that working interest in oil and gas wells is not considered to be a passive activity, which means that all net losses are active income incurred in the conjunction with production, which can offset ordinary income on W-2 wages. And oil and gas wells can deduct a large percentage of their tangible and intangible costs, which allows them to report paper losses. This one has so much risk that you are required to be an accredited investor, meaning that you have at least $200,000 a year in income or you have a net worth of $1 million. All right, moving on to number 14, get the timing right. from a tax point of view, there's a big difference between doing something on December 31st and then doing something on January 1st, because the second you cross over January 1st, you enter a new tax year. So any tax moves you want to make to reduce your taxes need to happen before the tax year begins. So starting a new business or side hustle, do it before December 31st. Dumping some losing stocks, do it before December 31st. Buying a new home, do it before December 31st. Okay, I think you get it. And this is something that many popular celebrities and companies do as well. Usually around November and December, you'll start to see more people donating cash and gifts. While that's great to see, especially around the holiday season, you should also know that you're taking advantage of tax deductions and timing it right. Now, the 15th tax strategy is not really a direct strategy, but it still is very important, which is number 15, keep up with tax law changes. Lately, there has been many tax law changes, from waiving retirement account withdrawal penalties to increasing and releasing new tax credits to increasing the percentages on the meal and entertainment deduction and so much more. So keeping up with these tax law changes allows you to always be in a position to where you can leverage the tax code in a way that helps your situation. And of course, if you don't have the time to keep up with all the tax law changes, don't worry. That's why you're subscribed to our channel, so that we can keep you up to date. All right, so that's a huge amount of free value. I hope you enjoyed this video. Don't forget to like, share, and do everything you can to help me spread this video around. All right, coming up next, we have 2 more videos that you may enjoy as well. So if you haven't watched those yet, make sure you do, and I'll see you over there.